I am Alan Safer. I'm the Managing Director of Integra Realty Resources, Seattle. We're located in downtown Seattle in One Union Square. And here's my contact information if you need any further information. We're one of many offices across the country. We have locations and services that cover the continental U.S. and as well as an office in Mexico. Institutional investors are flocking to Seattle. This is a change. We traditionally have been a secondary real estate market, but I believe in this cycle we've been upgraded to a primary investment market. Seattle is routinely cited as being a 24-hour global gateway, along with Washington, D.C., San Francisco, New York City, and Boston. We're among a handful of cities benefiting from expanding employment: Boeing, Amazon, Microsoft, but the real story today is probably Amazon.com. We're a 24-hour gateway to the economies of the Pacific Rim. We're seeing a lot of Chinese investors as well as investors from the Far East in general. And many institutional portfolios are underweighted in Seattle. I'm going to go over the major food groups, starting with retail. In the retail property, this chart, by the way, is from the Integra's Viewpoints publication, updated quarterly. And this shows a bell curve where we're at in the overall development cycle. And I've highlighted Seattle, which is at the very tail end of the recession on the retail component. And here's where Seattle ranks amongst neighborhood retail with the rest of the country, the best, the worst in the local market. Seattle's vacancy rate today is 9.75%, which is considerably above the top three markets, San Francisco, Oakland, and Los Angeles, but considerably below the worst three in the country. This chart shows cap rate trends for regional malls, community malls, and neighborhood/strip. And it compares and contrasts to the 10-year treasuries. This is the December averages shown at the bottom, together with the annual average 10 years. You can see that the spread has been maintained over time, but it appears to be a wider spread today than it has historically. That's simply because the cost of money is so low. Nationally, neighborhood shopping center cap rates have trended from the mid-8s in 2010 to about 8% at the end of 2011. These are some local cap rates. These are the most recent ones we were able to come up with. We don't believe anything is actually transacted in 2012 yet, although I believe there's one neighborhood center that's pending. And as you can see, the cap rates shown trend between 6.25% and 7.3%. The two June transactions really tell the story in the mid to high sixes. Industrial properties. As you can see, the climate for industrial properties is much stronger. We've passed the recessionary phase and have entered the recovery stage. And Seattle is amongst good company. I think this reflects most of the country. Contrast to the retail sector, the industrial market has shown widespread signs of recovery across the country. The number of markets in the recovery stage has increased from 7 in 2009 to 14 in 2010 and 28 in 2011. Seattle is experiencing decreasing vacancy rates, and rental rates are slowly recovering. Here we are ranked compared to the top three and the bottom three. Seattle's vacancy rate at 7.3%. Again, here's that same graph, that graphic that demonstrates the trend in the industrial property sector nationally over the last several years. Relative to 2009, cap rates have declined 50 to 75 basis points. The office warehouse distribution product has trended in the 8.09 to 8.5% range, and relative to the other property sectors, cap rate fluctuation has been minimal. Here's local cap rates within the Seattle market. Locally, through the first 6 months of 2010, cap rates stayed in the 8% to 8.5% range, but in the fourth quarter 2010, rates entered the sevens, and by the fourth quarter 2011, rates fell to levels not seen since the peak of the real estate bubble. Office properties. Here's that same graphic, shows the office sector cycle. Although many markets remain in recession, a large number have transitioned to the recovery phase of the cycle, including Seattle. The local office market is benefiting from the expansion of the information technology sector. Almost single-handedly, Amazon.com helped drive down the city's office vacancy rate in the fourth quarter 2011 to 12.4% from 13.6% at the end of 2010. This represents the ranking of Seattle nationally. The previous graphic, that 12.4%, that reflects the Seattle CBD. Office suburban is a little different. The vacancy rate is actually a little lower, but within the overall range, I think we're consistent with the overall office sector. Amazon currently leases about 2.5 million square feet in Seattle alone. By the end of this year, 2012, the vacancy rate is projected to fall into single digits. Here's the national cap rate trend. Over the 2010-2011 timeframe, national office cap rates trended to 8% to 8.5%. Local cap rates. Local Class A cap rates have ranged between 200 to 250 basis points below the national averages over the past 2 years, trending towards 6% to 6.5% in 2010 and down to 5.2% to 5.75% range in 2011. The most recent transaction being the Russell Investment Center, formerly the Washington Mutual headquarters, traded recently below 5%, 4.8%, April 2012. The City Center / Advana Bravern complex had long-term leases to Microsoft, and the Key Center, shown in this chart, is on a ground lease, which traditionally have between 50 to 150 basis points higher than leased fee. Amazon leases more than 22 floors of the 36 stories at 1918 8th Avenue. Their lease for 460,000 square feet in 2011 was the biggest for the area since before the economic downturn. Russell Investment Center, the former Washington Mutual headquarters, is multi-tenanted and shows a cap rate based on stabilized NOI after burning off free rent to achieve the 94% occupancy that is in place scheduled for 2013. Moving to apartment properties. Apartments is where the biggest food fight is coming and has been. Here we show Seattle still in the recovery stage, but climbing the chart, going quickly into the expansion stage. With regard to placement nationally, Seattle's vacancy rate of 5% is very close to the top 3 markets by vacancy rate, considerably below the bottom 3 markets. 5% is considered to be stabilized. Nationally, cap rates for apartments in general ended 2011 trending between 6 to 6.5%, which were down considerably from the 7.5 to 8% in 2009. At the local level, cap rates for urban mixed use began 2010 in the low 6s, dropping to mid 5% in the July 2010 and sub 5% by fourth quarter 2010. These cap rates are about 50 basis points lower than the suburban apartment cap rates. Here's a trend line. We don't know how long that's going to be going on, but right now we're trending below 4.5% for the top urban apartment properties. Here's some examples of suburban garden style. The one transaction, at Mill Creek, was the last of the big deals of 2011, and it came in at 4%. But there was considerable upside on some of the rents. I think the buyer assumed they were going to be able to raise rents significantly in 2012. Here's that trend line again, certainly dropping into the mid or high fours, below 5%, with that one exception, Mill Creek, being significantly lower at 4%. In both urban and suburban markets, apartment cap rates for larger institutional qualities are sub 5%. Deja vu all over again, to quote Mickey Mantle. Competition has created cap rate compression. Too much capital, tired of sitting on the sidelines. Pension funds and life company clients indicate they have 20 competitors for every institutional property that comes to market. The alternative rates of return are about 1.25% in short-term cash equivalents. Going in cap rates of 4 to 5% look attractive by comparison. The DCF analyses assumes rent spikes over the short term to rationalize the very high dollar per square foot or dollar per unit being paid. The Seattle area's average yields on trophy office, industrial, and apartment properties dipped to about 6.5% in the first quarter of 2012, down from about 7.5% a year earlier. Other cities, such as Houston, saw average returns fall to mid-7% range from the mid-8% range a year earlier. By contrast, Manhattan office properties recovered earlier and have been routinely yielding returns in the 5% range or below since 2010. As interest rates rise, which inevitably they will do, cap rates are expected to tick up, but spreads will compress between 10-year securities. In the absence of a commercial real estate building boom in the next 5 years, institutional investors will continue to aggressively compete for the best properties. This concludes our presentation. Integra Realty Resources, the nation's largest valuation consulting firm. If you have any questions, please contact the Seattle office. Thank you very much.